Hi, everyone. Welcome to the Canadian Passive Investing Show. I'm your host, Ava Benisaki, and I'm joined by my co-host, August Biniaz. We have another incredible show for you today. Please like and subscribe as it helps us build our channel and allows us to keep bringing you great content and expert guest speakers. Now, everybody knows our mission is to empower investors to earn passive income through real estate investing. Now, today we have two guests on our show, Mark Baltazar and Mike Rockall.
Yes.
And I'm just going to take a couple minutes to tell you guys who they are. Mark is the co-founder of Peak Multifamily Investments. With 5 years of real estate investing experience across various strategies, Mark oversees Peak's capital raising, client acquisition, partner relations, educational content development, while ensuring the company delivers on its promising of helping others build generational wealth through apartment building investing. Now we got Mike here. Mike is not only a realtor, but a full-time investor who has been in the real estate business for over 10 years. Mike specializes in investment real estate, mainly multifamily income properties. He personally holds a portfolio of multifamily apartment buildings in Hamilton and surrounding areas. His knowledge of the city's geography can assist with all real estate endeavors.
And Mike is also the co-founder of Peak Multifamily.
Yes, thank you for that. Now, we believe this interview with both Mark and Mike will bring great value to both passive and active investors looking to learn more about the Canadian multifamily private equity space. So welcome, both of you, Mark and Mike.
Welcome, guys.
Thank you. Yeah,
Thanks for having us.
Yeah, thanks for having us on.
We're excited to have fellow Canadians on our show.
Yeah.
This is going to be a great conversation. Why don't we start off with Mark? If you can just please tell us about your background and your start in real estate, and then Mike, we'll love to hear from you.
Yeah, so it started in 2015. So I guess going on 7 years now, and started, it wasn't in apartment buildings. It was, not cash flowing, but quick cash strategy. So flipping. So did a lot of flipping early on, did a number of flips. Held some along the way, duplexes. We had a triplex. Even Mike and I had a fourplex, early on as well, and then kind of shifted into apartment buildings early 2018 or late 2018. My previous background before getting into real estate was marketing research. So in the brand consultancy space, marketing consultancy. So working with large global brands. A lot of them actually based out of Vancouver, Canada, which was great because I was out there at least once a month, which was awesome. I haven't been out there in a while. So that was analytics and dealing kind of with strategy and stuff. And that, obviously helps, from a real estate standpoint, just, analytics, understanding numbers, financials, spreadsheets. And then also just from a marketing standpoint, like how to position our offering to the right people. So, it all, I think everyone's prior experiences all amalgamates at some point and, continues to benefit, as we build upon that. And so now I'm completely focused on, apartment buildings with Peak Multifamily. And as you said, our objective there is to help people build generational wealth through apartment buildings, whether it's, teaching people how to do it, right? Because I think it's becoming a more popular space. And then also acquiring ourselves with accredited investors.
Nice.
Mike, please.
Yeah, so a bit of a different story for me from a very young age, a teenager. I always thought to myself, if my parents had bought one other house and just rented it out, 25 years later, the mortgage would be paid and they'd have a massive retirement. So if I decided to buy something in my late teens, early 20s, rent it out, by the time I'm in my 40s, I have an additional house fully paid off. So a mentor of mine introduced me to RAIN, Real Estate Investment Network, way back when, I think 2006 or 2007, I attended their what was called Quick Start program, and just started learning, about real estate. Didn't know if I wanted to flip houses, buy and hold apartment building. Didn't really know much about what I wanted to do. But in 2010, bought my first investment property, which was a triplex, and kind of kept acquiring them along the way, partnering with friends, trying to qualify for mortgages, trying to kind of figure out my journey. Along those first few properties, I was in the process of getting into construction because, flipping homes, renovating homes, was something that I thought would work for me. So I did end up becoming a licensed plumber. So built a portfolio up to about 45 units, still working full-time as a licensed plumber. Then in 2014, kind of leveled up. How do I scale to the next level? And bought my first apartment building in 2014, still working full-time. At that point, I started referring off, like friends really started to notice what I was doing. And I was referring off friends, my fiance's friends to my agents, and decided, I believe it was in 2016 or 17, to get my realtor license, right? And passing off clients, mainly for, the investment side of things. And about I think it's 5 years ago or so now, I got my realtor license. Also building a lot of, investor networks and joining them and things like that. So really went full-fledged into sales from the apartment building side. So since then, really helping out bigger clients, things like that, working with, the top multifamily brokers across Canada, if not North America. And then decided, this is something I should be buying too, not just selling. Right. So we, in late 2018, kind of took it to a next level, and started buying apartment buildings, as fast and quick as we can. And yeah, since then I've been doing some pretty big deals with some bigger clients in the space, and, purchasing for clients off some of the bigger REITs, all across North America, and just gaining access and building relationships with some of the bigger brokers across the space in North America.
Amazing. And being a commercial broker is a great kind of foundation to have when you're trying to get into the real estate private equity space. And one more point about an item you mentioned about the parents, that kind of your parents, hey, if they would have just bought one more single family, that the financial situation would have been so much greater if they would have just rented out. But on that point, when I talked to a lot of baby boomers who at that time bought their primary residence, they did have more money to either buy in a much better place or buy a secondary place, and they decided not to, because real estate wasn't as it is, seen as today. It was seen as a liability, not really as an asset. And I want to probably what greatest investment to be made. So great point you made there. But
yeah, and thank you both for sharing a little bit about yourself and your background. And maybe you guys both kind of started a little bit small in the smaller, single family, and both of you. So maybe you can talk about, and we can tell people what piqued your interest about multifamily, and why did you start going after multifamily and the benefits of multifamily?
Yeah, I can start with a couple of points, and Mike can add as well. I think with a background in business, I mean, I was trained in school and also ran a business for a bunch of years. The commercial aspect, the fact that there's a multiplier, right? So I think like any business is valued using a multiplier depending on what industry you're in, and so the economics become pretty easy to understand. Your income goes to X, and that's typically how you value your business value is X, times 3 or times 4 or times 20, depending on what industry you're in. And so the concept of, commercial having more control in terms of growing value, being able to control a little bit more in terms of what the end valuation is going to be, it was where the light bulb went off for me. Because in single family, even flips, like even being flips, your valuation is highly dependent upon what's going on around you. And don't get me wrong, multifamily is as well to some degree, but I think there's more control because you can do more from an income standpoint and drive income upwards, which enhances value. So I think the control aspect of it is one piece. And then also the scalability, right? Like, I mean, instead of, having 2 units under a roof, now it's 20 or 30 or 40. There's efficiencies there. So from an operating standpoint, there's, economies of scale with that. And so, with our goal to continue to grow and expand, it just seemed a little more, I wouldn't say easy, but efficient to scale a portfolio buying, a property that has 20 or 30 units kind of under one roof versus 2 units under a roof. So I think that those are the big things, at least for me. Anyways, when I looked at it originally, I think that's how we operate our business today.
Great. Mike, please go ahead.
Yeah, what Mark said is pretty much it. I'll just add one point to that. Was for me, it was mortgage qualification. And some of the single families I just ended up selling in 2020 because they were holding so much equity, but I wasn't able to refi them.
Yeah.
Right. So just in the single family space, it's very difficult to qualify, or you're finding the next, partner to qualify. Whereas multifamily, as you guys know, it's a different qualification process. So for that scalability is what really, said, hey, if I want to get to, thousands of units, it's going to be very difficult in the single family versus multifamily.
Isn't that something? And a lot of people don't know that it's actually easier to get financing for multifamily than it is to scale a single family portfolio. So I'm happy you said that. Now, Mark, you were mentioning this, creating income in these multifamilies, which really drives the value of the asset, which is really exciting. So I want to talk about the value add, this business model that makes multifamily so attractive to so many veteran investors. And what I like to call, we always say this term, it's a wealth building machine. Okay, so we educate on how wealth is built through the value add. So let's go into detail and discuss how is it possible for a renovation of a property, multifamily property, which then allows for higher rents to increase the NOI, but this increase in NOI results in this exponential value appreciation and creation. So let's talk about that for people listening, because it's really exciting stuff.
Yeah. So so that's the strategy. It's the value add strategy. So so maybe we'll break it down a little bit. So we're buying. So value add by definition is, there's room on the table to grow the valuation, right? So grow the the value of the property, and so we're buying properties that are undermanaged, right? They're underperforming as to what they potentially could do from an optimal standpoint. And so, let's do maybe quick math, right? So commercial assets, all commercial real estate, and obviously this, multifamily as well, is typically valued using kind of a capitalization method, right? So for every dollar in income, there is a multiplier effect in terms of its valuation. So every time, so let's say we take a unit and increase its rent by $500, right? And, cost aside, let's kind of keep the renovation costs to just assume that it's, $40,000 or $50,000, whatever it may be. So at the end of the day, you're increasing net operating income, essentially, assuming all else stays the same by $500. Well, that essentially is going directly to the net operating income line. And depending on what market you're in, each market operates with different cap rates, as you guys know. But just to keep it simple, let's say we're operating in a market that values buildings or is trading buildings at a 5% cap rate, right? So every dollar you're increasing the net operating income, you're essentially 20xing the value of that building, right? So a $500 increase in net operating income is essentially, geez, what's the math on that? 100,000 in terms of incremental value, just by increasing the rents by $500, let's say. And so that's one unit. So you multiply that by 20, 30, 40 units. I know you guys are doing things that are in the hundreds of units. And so you can start to see the benefit of having multiple units under one roof. You can start to see the benefit of the commercial or the capitalization method of valuation. And that's kind of how commercial properties are valued. And so that becomes a pretty formulaic way to grow business and grow value. Now, there's nuances that you have to, it's not as easy as that always, right? There's processes and procedures and dealing with, tenant laws and such, but the math is pretty straightforward. And so I don't know if if that answers the question, but depending on the market, you're essentially, you have a 20x, or it could be 25x, depending, or even a 15x on your, for every dollar increase in net operating income.
That's awesome. And yeah, multifamily is vastly different from single family, where you renovate a property and you look at the comparables in the area to determine the value of the property. Multifamily is determined by the income it's producing,
yes,
divided by the cap rate, as you're mentioning, and that equals that. So if you bump the NOI up, you're looking pretty good for that value creation. So it's really exciting stuff.
On our recent Houston, Texas deal, I mean, we are approximating $2 million in renovations that are going to be spent by us, and that's going to create $10 million in value. And when we break that down for our investors, it really, you can see the spark in their eyes, this concept of creating, the forced appreciation that exists. So we're not only relying on natural market appreciations because we are astute and we invest in markets that show certain growth metrics. I'm talking about us and you guys, but you're also going in there and creating forced appreciation by adding value.
And that's really within the first 2 years of owning the property, right? However you can get the renovations done. Just in the first 2 years, $10 million of increase. That's pretty powerful stuff.
Mike, would you like to add anything to that?
Yeah, I was just gonna say, in terms of like the area where you're investing, there's certain areas call for certain things, right? We're, just on the outskirts of Hamilton now in a new market. We've done a walkthrough of the building. A lot of people are asking for storage. Where am I storing my winter tires? So there's a demand, right? So when you're talking about net operating income and you're looking at that, 20x on every dollar, you start looking at the highest and best use for that property. Can I build a shed and charge them $50 a month for storage, right? Just offside the property, right? So it's just finding that highest and best use for the property. There's also things like that we speak to a lot of investors about, is like doing a new roof or repaving the driveway. There's no direct increase in net operating income when you're spending that money. But yeah, I think you have to dig a little deeper. Are you getting a better tenant profile if you have a nice parking lot with new painted lines? If your hallways stay cleaned, are you getting that $50 more in rent, right? And the other thing that we've noticed is having like a professional property management company. So newer people getting into the space, they're kind of managing their self-managing. And when they're filling out applications, it's kind of, here, I'm going to email you just this whatever generic application, right? Professional tenants in terms of like people with good jobs and stuff like that, but they're not able to purchase a place. They'll pay a premium to know if something's wrong with my unit. If I have a leak, I have a professional property management that's on it within a second, right? So there's small things that people don't really see that do impact their net operating income. And it's something you have to keep an eye on, because having those, parking lots paved, snow plow, within a couple hours of when it snows, things like that do attract that better tenant, which will in turn pay more money.
Not only pay more money, but also reduce the cost of potential litigation if they break a lease or they don't come. The demographic becomes a better, tenant demographic and better profile. So great points.
Yeah, great points. Okay, guys, let's chat about real estate private equity. Raising capital is very crucial component of our business. Maybe talk to us about your experience with one of your early multifamily investment opportunities, and how difficult was it to raise capital? Because it's not an easy thing to do.
For some people it is, if they can call their, family or they say, hey, I just need like $5 million. And, so, but go ahead, guys. Tell us.
We all don't have that golden phone call that we can make, right?
Yeah. I mean, I think the first, I'll talk
Mark,
about
your mic is rattling a bit, or as you speak.
How's that?
Yeah, don't play with it.
Okay, got it. Good point. So I think the first deal that Mike and I collaborated on or partnered with on in kind of peak multifamily, I think we had, so friends. There was friend in there that was an investor, or that is an investor. Again, that's kind of, done business with us before and has done, other projects with us before. So very familiar with kind of what we're doing. And I think there was, one other, and it's harder, right? It's harder because again, you don't have the track record quite yet, right? Like you might have a real estate track record, which helps a little bit, but it's a different strategy. So, and then I think as you start to build a portfolio, then, people around you start to notice and want to get involved. Right. So I think track record is really important. Especially, investors are putting money, their hard-earned money into these types of projects, right? They want to know that you're managing it properly and that the projects are gonna perform. And so you can really only rely upon track record. At least that's the best indicator someone may have of what your future for performance may be. So I think the more deals you get into, I don't like to use the word easy, but capital starts to be less of an issue. And I think deals become more of an issue, right? And inventory. So I think, as people start out getting into that first deal, and I think maybe partnering with somebody that's doing deals just to start to build the knowledge base and even track record to go, if you're going off on your own, then it's important to at least get some experience with someone that's been doing it or doing it.
Great. Mike, you've been in this space for a long time, so I'm sure you've dealt with investors early on. Talk to us about one of your early deals and how was that process? Maybe tell us a quick story, if you may.
Yeah, it was very difficult. So obviously started out with my own capital, maxed out. And then I had a good friend doing kind of the same thing. He maxed out, and it's like, well, how do we get into the next one? Kind of partnered together, so it's less capital. And then friends and family that you speak to don't want to invest with you. You know, there's always that stigma of real estate. They're not educated. What happens if tenants don't pay this, that, the next thing? But, you know, long and behold, one friend comes along, you purchase another one, right? Years go by, and that, you know, family, like my partner's parents, who didn't invest with us for some time, 5 years later, see us, you know, very successful, doing well, sold a property, made some good money. Now, you know, the bell starts going off in their head. You know, shit, we should have done this 5 years ago. And they're kind of phoning, hey, is there a property? We've been thinking about it more, and kind of just started to spiral after that, right? People were calling me to say, hey, I see what you're doing now. We really like it. How do we get started? Right. And, you know, to be honest, a lot of them I was telling you can probably do on your own. Like if you want to be hands-on, and that's to the point when I was telling you my story at the beginning, I was passing people off to agents I was using. If you're comfortable managing, but a lot of them were, you know, career oriented. So it's like, no, I don't have the time. I don't want to manage it. You know, let's partner up. And then obviously from there, things started to take off. Friends, family, people were calling me. And then, you know, one thing after another, that's how it started. But the first, I would say 3 to 5 years, they were a challenge, right? You didn't have that track record behind you. People didn't really understand it. And you're trying to, you know, and then like me just getting into it, I'm so excited. I want more property. So I'm probably talking a mile a minute. They don't understand 75% of what I'm saying. They think it's risky, and it's not for me. Right. And that's what tends to happen. But then after, when the experience kicks in, you know, it's like, too bad if you're not in, somebody else is going to take a part of this, first come, first serve type of thing. But yeah, first 3 to 5 years were a bit of a challenge.
Yeah, and I love that he said like when he closed, people are like, "Oh man, I should have got in," but people don't understand it at first. But when you go through that full cycle, they see the proven results. You're like, "Look at this! This is amazing."
Yeah, talking about calling friends and family. Imagine on our first deal, which was a $92 million asset, USD, so that's well over $100 million Canadian. Giving a call to my friends and family, "Hey, we're closing on a $92 million. Would you like to come in at 25K?" They're like, "What? What are you talking about? You used to build single family and multifamily. You're buying a $92 million asset in Orlando, Florida." So yeah, definitely a bit of a shock there.
It takes time.
But staying on the capital raising topic, I mean, we are, we're not fund managers. We don't create a fund and continuously buy assets and continuously raise capital. We're project specific. We create a single purpose vehicles for a project specific multifamily project. So. And what the difficulty that it creates is since we can't raise capital all the time, we have certain limitations when it comes to getting capital from our investors. So maybe this
it's a pretty tight timeline. But Mark, as you head Peak's capital raising ventures, please discuss with us your strategies when it comes to this really important concept, nurturing and cultivating relationships. With investors, and then how you nurture those relationships while you await a deal to be available for your investor community. So kind of.
No, it's a good question. So I think, part of our company platform is to educate as well. So, we're putting out a lot of content to help people just understand the space a little bit, because it's a little bit of a black box. I mean, like anything is, right? You get into something new, it's a little bit of a black box in terms of how things work. So we put out a lot of content in terms of just how the commercial multifamily space works, the models, the stuff we just talked about, the math we just talked about. Although I recalculated in my head, the math that I gave originally was incorrect. It's way more than that. It's actually $240,000 lift approximately. But anyways, it's
you under promised and over delivered.
Yeah, that's right. So we're coaching people as well. We have a course out there. So that's a way. So in that, like you guys just mentioned, there's people that want to get into this space, but again, they're professionals. They might not, have the time, and so learning about it and realizing what's actually involved, kind of step by step process. They realize, like, you know what, this is probably, I like it. I like the asset. I don't know if I could spend and dedicate. It's a business, right? Like, I mean, it's just something probably you shouldn't be doing as a hobby. You do need professional management. You need someone that's kind of acquiring and managing these assets. So that's how we continue to stay, I think, relevant to people and out there, and ensuring that when people think about, hey, I want to understand apartment buildings, or I want to buy an apartment building, or perhaps I want to partner with somebody and invest in apartment buildings, we come to mind. So that's kind of our cultivation and kind of always on or top of mind brand strategy. And yeah, and I think it is a challenge actually when you're raising deal by deal, because there's a short amount of time, right? We're not collecting funds beforehand, and we're also not going out specifically marketing for that either. There's an opportunity that we have, and people that we know, or accredited investors have an opportunity to jump in on that. So there is a little bit of there's risk on our side, right, in order to kind of get these deals done.
Great points.
Yeah.
All right.
I just wanted to touch base, like some people that are investing in duplexes and triplexes that do want to level up, they start to realize that deal sourcing is also a challenge. So throughout our course, we've had multiple people ask, how long do we sit on the sidelines? We can't seem to find a property, or the one we find is going quite a bit higher than we think we should be paying. Should we just be staying in single family? So they want to level up, but they can't find that property. So over time, it's like, guys, we want to get into this space. We understand it now. And that's how capital comes in as well, right? Just because the lack of opportunity to source deals.
Right. It's not an easy thing. Yeah.
Great point.
Yeah.
All right, let's switch the conversation a bit here and let's discuss the elephant in the room. We at CPI Capital, we've been talking trash about the Canadian multifamily market for years now. So the low rental yields, negative cash flows, the rigid mortgage laws, and the high cost of material and labor, and most importantly, the investment culture that I always speak about, where Canadian passive investors are much more conservative. They're hyper cautious than their U.S. counterparts. So peak multifamily has seemed to have just leaped over these hurdles and is flourishing. Yeah. So tell us about how you achieve success in this sector that has such slim pickings. The Canadian multifamily private equity sector.
Okay, so I have a quick question for you. What do you find so negative? You say you're trash talking the Canadian market. Is it the ability to source deals?
No, I just listed them. So for example, some of those issues are they're low rental yields. So rent to value ratios in Vancouver and Toronto are much lower than they are in the US. In most cases, if you do a conventional mortgage, put down 30%, borrow 70% from the bank, you're in extreme negative cash flow. So that's one concern. Whereas in the US, particularly in the Sunbelt states, the rent to value ratios are high. You could put down 30%, you'd be well into cash flow. So offering that when it comes to a syndication model, your investors are receiving cash flow, where in Canada that wouldn't be the case and cash flow becomes non-existent. The other issue is mortgage laws. I mean, in the US, they're much more business friendly. The ability to get mortgages is much easier. You also got tax benefits on the US side when it comes to depreciation and cost segregation and bonus depreciation. Just the process. And then again, the last point was the culture. The Canadians are very hyper cautious. They're very conservative. Ava has to be on multiple calls, in-person meetings before somebody kind of invests with us. Whereas our US investors, we say, hey, how you doing? On our first call, what's your minimum? It's 25. Okay, I'll invest 50K.
Yeah, We're going to transfer the funds. I'm like, I just talked to you for 10 minutes. What are you talking about?
So those are the kind of concerns that we've seen. Also, like the market, the U.S. is over 300 million people. There's an interstate migration happening. The kind of job growth and population growth that exists in Texas and other states. You're not relying on people coming from China or other places in your economy. Something happened, like in Vancouver, being a real estate guy here, something would happen in China and would affect our market here. So in the U.S., you don't have those concerns, or not nearly as much. So I mean, the list goes on and on, but yeah, and also like on the property management level as well. U.S. property management firms manage your property, manage your leasing. They also do the renovation. Not a single property management firm ever in Canada that I've heard of that does management and renovations. So just so many different.
But talk to us, guys, because we have lots of Canadians that want to invest in their own backyard. So that's where you guys come in, right? So.
Mm-hmm.
So I'll touch base on the financing first of all. So if you're typically, and there's so many different tools. So if you're typically doing a lot of the deals that we're doing with conventional financing, you're right, it doesn't work, right? But what's typically happening is, say we're in a market that a conventional lender will look at it and lend at a 5% cap rate. What's happening is all the purchasing going on is typically around 3.5 to 4. I would even say more of a turnkey product with not much value add, say 4.25, right? But the lender's lending at a 5 cap. So yeah, you have to put 50% down when you're doing conventional. But there's a lot of lenders out there, which we use, that they understand the market. They're taking on a little bit more risk. Yes, interest rates we're paying are in the 5% range, but they'll do 80% loan to appraised value. But typically the appraisals are coming in at that 3.5 cap, right? And because you have, not in all cases, but because you have that lender that's a little bit more flexible, more of a private lender in terms, they're allowing a second on it. So one of the last deals we did, we went 90% loan to purchase, right? So we're in with very little money. Now, yes, it's negative cash flow for sure. We're structuring our second as a balloon, but the actual rent spreads, like one of the other buildings we bought in Hamilton, we ended up turning 18 of 19 units in the year. I think the average rent was $780. We're now getting $1,950 for twos, $1,650 for ones. So yes, we bought it at a low 3 cap, and now it's going to be appraised at just over a 4 cap. There's a lot of value to be had, right? I'm not super familiar with the market in the States, but I don't think you're seeing $1,000 plus rent spreads where something's rented for $700. If you get them out and renovate, you're now getting $1,000 a month plus.
Let's talk about get them out. Let's talk about that subject briefly. So in all the states that we invest in, and they're reds, the Republican states, red states, there are no rent controls. Talk to us about the rent control concerns or other issues that exist here as well.
Yeah. So when you're talking about, and this comes down to the underwriting at the beginning, when you're talking about $1,000 rent spread, and you know that your appraisal for a turnkey will come in at 4.25 or less, depending on where you are in the transition. Mark, what if you can do it quick, just $1,000 a month times 12 divided by, say, a 4 cap in the markets typically that we're in, it's got to be 280, 290.
Yeah, 300.
300. So you're factoring in, say, a $50,000 renovation. If we have to factor in, and sometimes, like when you're talking to tenants, they want to move, right? A lot of the building is run down. They don't really want to be here. They moved in, it was cheap rent, and they've wanted a way out. So we kind of take that approach to say, we do want to renovate. We want to help you along the way. We're willing to compensate you. And we'll take them literally by the hand and have a leasing agent show them other properties. And sometimes, like, say they're paying $700 for that particular unit, a very comparable unit is maybe $1,100 now, not renovated, right? So they're going, okay, $400 more. What should I do? But if you were to offer them, say, $25,000 to leave, they may say, wow, this is going to cover my rent for some time, or this is going to allow me to put a down payment on a house because my income's there, I'm trying to save. So yeah, cost, you say, we've never had to pay 25,000, by the way, but I think the last one we paid 20 was the highest we've paid. And it was actually a $1,200 a month lift. She was paying 7 and change, and we're getting now $1,950. But yeah, 50 for the reno, 20 to leave. You're still getting that value of $200,000.
Sorry, Mike, right? You're paying $20,000 to someone to leave a unit?
We have. That was the most we've ever paid. But the lady was paying,
American
I think,
friends are like right now, our American friends are whoever will watch this video, like that will just blow their mind. You know, I
Yeah,
mean,
But
it's
it's like, so, but if
but
you do the math, so it's like, okay, so 20,000, let's say a $40,000 reno. So you're investing 60,000 to get a lift of about 300, 320. So that's how we do our math, right?
the
It's like,
economics
okay,
make sense. The numbers
Yeah,
make sense. I totally
yeah.
understand that, but I'm talking
yeah.
about a system that's made for the entrepreneur to fail. The system is against us. You got to understand that's the difficulties that we go through here in Canada, not only on the kind of entrepreneurial scalability, but also on the taxation and the highest tax bracket. I mean, so many different issues that exist. I'm not sure how much more you guys want to chat about this topic, but I would love to keep talking to you guys about it.
Yeah, no,
yeah,
I
no,
think,
go
I
ahead.
think like anything, there's trade-offs, right? Like I think the ROIs that have been achieved, and again, there's like, billion-dollar REITs that continue to buy in this market and buy in the US, but their portfolio is still skewed towards this market. It's risk and reward. I think the buildings that we're turning over and the strategy has generated 30 plus annual returns on these buildings, which I think is a pretty good return for the building. So this one that Mike's talking about even more because we've been able to turn so much. But yeah, there's challenges that you have to overcome, and I think we built a system that's enabled us to do that. You're right. We're buying properties that don't cash flow out of the gate. So that's got to be factored in, right? So there's a lot of capital expenditures, but when it does, when we do turn it over, there's market appreciation, which I don't again, not so familiar with all the markets in the US, but I don't think you see the market appreciation that we see here in the US. So there's the equity growth that happens, and I think a lot of the people that we partner with, they're professionals, professional income. So they're not looking for cash flow right now. What they're most interested in is putting their, the capital in a safe asset that's less volatile. So you don't have the volatility. But they know that the equity is growing because, again, we're in a market where immigration is a big part of it. As you mentioned, population's growing and rents are double-digit rent growth, at least in the markets that we're in. So again, we're specifically targeting markets that have good transit, have population growth, and have experienced double-digit rent rate increases every year.
We love it. We love it.
And I want to touch base on the $20,000 that you do get natural turnover. Typically in any building over a 5-year period, you're probably getting 25 to 50% natural turnover, right? Then you're having these tenants who want to, leave, you cover their moving costs, they're going to leave. It's the one-off that you're paying that much here and there, and they're willing to say, yeah, I know, like they're very appreciative, the tenants. Thanks a lot. Like this is going to help us go a long way, but it's not every tenant we're paying 20,000, right?
But just like Mark said, the numbers make sense. Even if you had to pay it, as long as that's part of your pro forma, if it makes sense, it makes sense. Totally. For us, certain other capital expenditures make sense. This is the same kind of concept. I was looking more as a young entrepreneur, or maybe not young so much anymore, but I felt like the Canadian system was made to make young entrepreneurs fail and is to dismotivate from people to become entrepreneurs, and at so many different levels. And in the US, I've had so many professionals who've made the move from Canada to the US, and they're like, you guys are crazy spending any time there. Move to the US. We plan to move to the US. Obviously, we always keep our Canadian roots and heritage, but if you want to do business and you want to scale your company and your business, the US is the place to be. And you can see that with so many other companies around the world that have
But for our conservative Canadians who want to invest in their own backyard, we would love to do a deal with you guys because you guys really know your stuff.
Definitely.
And I just want to touch base. Mark brought it up quickly. There are REITs in Canada that own 20 billion plus of assets, and say 5 billion is in the US. And you wonder, how come they're keeping 75% of their portfolio in Canada? And you start digging deeper, there's got to be reasons. It's not like they don't know about the States. They're holding, $5 billion worth of multifamily in the United States. Why in Canada? Right? There's got to be something.
On the reverse of that, as I'm very active on LinkedIn, I see a lot of other larger private equity firms who are switching to investing in the US, where in the past they never did. So there's also a transition happening on that side as well. Again, the conversation doesn't need to be about which one is better or not. I think
They're both
we've
great.
easily won that debate.
Oh, God.
But the thing is more about it's more about
so crazy.
having a business model in the region you're on and being successful in that business model. That is the key, and you guys have achieved that. Doesn't matter how
guys
you
have.
achieved it. If you achieved
Yeah.
having to pay someone 20 grand to move out, doesn't matter how you achieved it. It's all about returns to investors, profits to investors, and managing a great company with the same business model that we utilize in the US, and you've been successful
You
at it.
guys have
So
been
all the kudos to
successful.
you guys.
And yeah, and I would like to discuss the educational platform that you guys have now. We love this, as we at CPI also have our extensive focus on education with our YouTube show, meetup groups across Canada, and then many of the content we create and we send out to our community. We pride ourselves in real estate, as a real estate private equity firm that takes educating its investor base very seriously. So maybe you guys can talk to us about your educational platform and how you go about staying up to date and everything like that.
Yeah, so I can touch base on that. So, I mean, it started off, I guess, with the podcast. I mean, we the Canadian Multifamily Investing Podcast, and really the goal and the purpose of that was just to educate people, to demystify multifamily investing, specifically in Canada, because I was in the U.S. I was in the U.S. At a conference in Texas, I don't know, 2.5 years ago, and with a lot of kind of the top syndicators. And the big thing that I realized pretty quickly is that there was no one really talking about multifamily in an educational way with a podcast and some of the stuff that we're doing. And so we found that there was an opportunity there. And so it was really about educating people and kind of bringing people up to speed as to the different types of strategies to invest in commercial multifamily in Canada. Then with that, then came the questions about, hey, do you guys coach? Do you guys, what else do you guys have? And then we did a number of, it started during COVID, so it was kind of live online, training programs, 3 days or over a weekend, for example. And that's evolved now. You can buy that online. 15 hours of training on how to buy your first apartment building. And so we kind of go through all the steps that we go through, and we provide all the documentation that we use ourselves on a daily basis. And so that's evolved as well now to coaching, and we coach one-on-one, students that are getting into or buying their first deal, even those that are buying their second and third deal, just to help them review and underwrite and understand different markets and different kind of the economics of multifamily. So in a nutshell, yeah, that's kind of a part of our business, and it's helped with the content creation, and it helps. We think it's helping a lot of people.
That's awesome.
Yeah. Our educational stuff helps us educate ourselves as well. As we have expert guests like you guys, we learn a lot from our guests. And when we have to write a newsletter or we have to write a paper, there's a lot of research that goes into it. So it educates us and keeps us up to date. Okay, excellent.
Incredible. Now, before we move on to the next segment of our show, I'll ask you first, Mark, and then Mike, you can answer after. But please tell us, what is your number one advice to a passive investor looking to start investing in real estate, private equity?
I think, the deal, obviously the deal, understanding the deal is one thing, right? That's, you're going to look at the economics, but I think looking at the, whether it's the sponsor or the lead partner or the people, the group behind the management, understand their track record. What have they done? Make sure you interview them, perhaps get, referrals, or, testimonials. So I think it's really like any business, it's really the people behind it. Because you could have a great asset that's run poorly, right? And you can have a poor asset that's run, in an amazing way and turned around. So I think really understanding the people behind it, I think is a real important component. That's where I'd spend, my time if I was investing in someone for the first time. Is who are they? What are they doing? What are their principles? What are their values? And what have they done in the past?
Great advice. How about you, Mike?
So that by far is number one. They have to know the people behind it. They have to feel comfortable. Another piece of advice is just kind of really understanding what they're getting into, right? If it's a contract they're signing or an OM, what does it really say? What are their exit strategies? A lot of people get into these things that looks all bright and shiny, I want in, but without really understanding what contract they're signing, how long the term is, what the investment really is. But yeah, I would just say, really get to know the people, know their history, as Mark mentioned, and then understand what you're getting into. Like, this is your hard-earned money. You're investing it. And some people don't like to own up. Like, if that money gets lost, it's like, oh, those guys lost my money. Well, no, you're educated. You've saved this money. Like, you have to do your due diligence on it as well.
Yeah.
Also terms as well. Sometimes,
Yeah.
our terms are just forecasted. On our recent Texas deal is a 3-year hold, but they're depending on where the market is in 3 years, we might hold it a bit longer. So that understanding that there's some level of illiquidity in the investment in real estate private equity.
And as Warren Buffett says, never invest in a business you cannot understand.
Yeah, for sure.
All right, so 10 championship rounds to financial freedom.
Next segment of our show, we're going to rapid fire this, but take your time answering the questions, whatever comes to mind first.
Yeah, let's start with you, Mark, okay? We'll start with you, and then Mike, you can answer right after. So, number one question. Mark, who is the most influential person in your life?
Right now. Wow. Who is the most influential? Okay, I would say in terms of support and allowing me, just even kind of doing what I'm doing, because I think, in business you're taking a lot of risks, and even transitioning from a consulting practice that I was a partner in and moving into something that's a little more unknown and risky is my wife. I mean, she, no matter what what kind of I'm pushing, without her support, and also 3 kids too that are supporting as well. So, I know people that don't have that support at home, and it's tough. Like, you can't perform optimally without a supporting partner. No matter kind of what else you have around you. I think if at home there isn't that rock, then it's tough. It's really, really tough. So I think for me that, without that, I don't think I'd be able to be doing what I'm doing and push kind of where Mike and I are pushing.
Awesome.
Yeah, nice.
How am I supposed to follow that without saying my wife?
Most guests say their wife. We just think that all
really?
scared of their wives or something, but everybody
really
so cute.
interesting.
Yeah.
You know what though? Outside of like family that supports you, I've built some good relationships with people who are way above me, but in the same space, right? So as I mentioned, being a broker in the space, I've actually built some really good relationships with a handful of top brokers that have been in this industry for 40 years, where I can pick up the phone and say, hey, what's your opinion on this? What do you think? And I know I'm going to get a really genuine response, right? To the point where I've had someone tell me something and then call me back and say, you know what? I'm going to tell you what I would tell my son. This is the advice I would give my son. But yeah, it's just building those long relationships with people ahead of where I want to be, right? So some really top brokers in this space have allowed me to kind of change the things that I do.
Incredible. That's
and maybe the
awesome.
next question we can start with Mike, so we go back and forth. So
Sure,
it's not just
yeah.
following up Mark's.
Okay, Mike, what is the number one book you'd recommend?
So for people starting off, it's definitely Rich Dad Poor Dad. That was the first book that I read, and it was an eye opener. It was definitely an eye opener, just having the Rich Dad and Poor Dad and way you view assets and liabilities, and it opened me up to a whole new world, so to speak. So I would say that's the king of all is Rich Dad Poor Dad, Robert Kiyosaki.
The Purple Bible, right? Mark, how about you? What's the number one book you'd recommend?
Yeah, it's fun. So I actually picked up Rich Dad Poor Dad again. I bought a version for my teenage son and other kind of versions for my other kids. It's super critical. I think so beyond maybe even real estate, I think just a business book that I read again probably 15 years ago and read it again last year, about 18 months ago, is Built to Last. And it's just it's how to do how to build a business where you can potentially step away from at some point. Because I think we're all active in business, and we obviously enjoy it, but at some point everyone wants to become passive in some way. And so I think there's a specific mindset that you need for that, and building things from the ground up the right way. So that's a pretty good one I'd recommend.
Nice. Okay. Right on.
I don't know if you guys have read it. I forget who the author is, but I think Tony Robbins is who recommended it. As a Man Thinketh. I don't know if you guys have heard of that. It's a very short read, I'll see if I can get you the information. I haven't read it in years, but pretty powerful.
Awesome. Love it. All right. Mark, if you had the opportunity to travel back in time, what advice would you give your younger self?
Well, I mean, start earlier for sure. Like, I mean, so my wife and I think we talked about investing in real estate for probably 5 years, and we didn't do anything. I think, oh yeah, next year. Oh yeah, we'll do that next year. And then, time goes by fairly quickly. And so definitely start a lot sooner. Um, you know, I mean, Mike started very early, right? And there's a lot of examples of people we know that started kind of, 19 years old, 20 years old. That's amazing. Like, you do that, you buy a property or invest that early, that it's life changing. So right now we're doing that with our kids, right? Kind of open up a stock account for them and kind of just getting to understand like why we have these buildings, right? Even going to the buildings with them. So I think the sooner the better. And I think this, demystifying this idea that you have to be rich to get into real estate. I think that's something that, or have a lot of money to get in, that held us back for a long time. So understanding how creative financing works, and I think whether you're in Canada or the US, the same thing applies. Understand how that works, and you can get into properties without being wealthy.
Nice. Now, Mike, you got started early, so I'm curious, what advice would you give your younger self?
I would tell myself to be a little bit more aggressive. So, the whole buy real estate, then wait, don't wait to buy real estate. I did start early. There was, I think, opportunity to buy more, but you're always thinking you're overpaying. What's the market going to do? And I did purchase some. I just wish I had purchased more. And I was probably in a position to like refi some of the properties, and double the portfolio. And that would have definitely paid off.
I thought after the earlier conversation we had with Mike and Mark, they were going to say, "Don't buy in Canada, only buy US." That's the advice.
That's funny. I was gonna say that as a joke, right when I came on. Just buy in the US.
Oh gosh, that's hilarious. Okay. All right, Mike, what is the best investment you've ever made?
Best investment I ever made. Probably the first building I bought in 2014.
Nice.
It's probably just tripled in 6.5 years. I don't even know what the ROI is on it anymore, because it seems in when we're investing is every 6 months values are way up. So just for an example, I paid 60,000 a door, and we're looking to sell things, north of 260.
Wow. Nice.
So in a short period of time, yes, there was some rentals in there. The cap rates were really high. I think when I purchased, cap rates were about 7%, and I got financed at 6.5%. I'm thinking, oh, I overpaid here. What's going on? And now I can probably sell it with the net operating income just about doubled. I can probably sell it at a 3.5 cap still in today's market.
Wow.
Nice. How about you, Mark? What's the best investment you've ever made?
So I'd say mid 2014, I took this, weekend seminar, about real estate investing. It was like, that was the time I was like, okay, now let's kind of get moving. And then there was like a decision between, a US program and a Canadian program, and, starting to invest in RAIN and education. So I think, the education, I think is, once you, like, if you're thinking about real estate, or it doesn't even have to be real estate, or, wherever you're going to kind of invest money, is just kind of educating yourself on whatever that is, whether it's kind of stock trading or options trading or even cryptocurrencies or whatever it is. I think investing in yourself first, just to get educated. There's a lot of free stuff out there right now too. I found that I think the free information on YouTube is good. It just takes a longer time to really get kind of to the nuts and bolts of how a strategy works. So I think pay for coaching, pay for courses, pay for membership into meetups or masterminds. I think that's going to have the biggest long-term impact.
Nice. All right, next question, Mark. What is the worst investment you've ever made, and what lessons did you learn from it?
The worst investment I've ever made, man. There's some flip properties I lost money on. Those were good lessons. But you know what? With those, there's lessons, right? So I think, I think if you ask someone if they haven't lost money or lost or kind of, been defeated in some way, then they're probably not telling you the truth. But there's real lessons coming out of that. Like, I think those losses were, not carefully managing things, not carefully managing, people, and assuming that things are being taken care of. So I think those losses, they're not even losses. I mean, they're real learning opportunities. They hurt, right? They hurt financially, but I think without that, you can't really grow as a business person. And we all have them, right, at some level. And maybe it's not financial loss, but it's time loss or partnership loss, whatever that may be. I think in all those things, it's like, okay, well, I went through that for a reason. I probably shouldn't do X next time, right? So yeah, so I think, some early real estate losses were important to, I think, kind of, the success we're having today.
Awesome. How about you, Mike? What's the worst investment you've ever made, and what lessons did you learn from it?
It was a flip that turned into a build, which one of the partners on the deal, I guess, wasn't managing properly. Ended up taking double the amount, if not triple the amount of time, and ended up losing money on the deal.
All right. We learned from it. Okay, Mike, how much would you need in the bank to retire today? What's your number?
Oh, I don't think I would ever retire today. Like, if someone gave me $1 billion, I would just be off investing it. Now, I might, if I won, say, $100 million today, I would probably consider switching up the business model and maybe investing some with other people, other companies, diversify, startup companies, and probably be a lot more passive. I wouldn't be as active as I am today. But yeah, I would say about 100. If I had $100 million in the bank today, that's where I would really shift gears. Until then, I mean, I would probably still be doing what I'm doing.
Nice.
What surprises a lot of people is what I say is, if I had $100 million, I'll probably get way more busier than I am now. So that's.
How about you, Mark? How much?
I don't know. I think, I'd get bored, I think, in terms of like what, the traditional sense of retirement. But I think with like 5 million, like cash, I think there's enough things you can do passively that, you have options, you could spend your time working or not working. So I think you can generate some good passive cash flow, even at 10% with, 3 to 5 million, right? So, and 10% is very low, right? Like 10% is very low. So I think that generates, 400K a year, 400 or 500K a year, just in really low risk passive investing. So that would be my number.
That's awesome. Yeah. So everybody listening, did you hear that? You want that cash flow coming in. So whatever creates that cash flow, you're good to go.
Exactly.
Great answer. Okay, Mark, if you could have dinner with someone dead or alive, who would it be?
Dead or alive? Huh. I mean, I think it would Elon Musk would be I think I was going to say Warren Buffett, but Elon Musk, I think Warren Buffett's very well published, so you can kind of get a sense of his thoughts. But Elon Musk, I think the way he thinks about things is very practical, but deep. I think there'd be a lot to learn. And he's invested. He's an investor, and he works hard, and he has, a formula. I think his achievements are somewhat formulaic, I think hard to duplicate, but he's obviously followed a process. So I think understanding kind of the inner workings of his brain would be pretty fascinating.
Nice. How about you, Mike?
Probably Tony Robbins. I think he's just got a well-rounded perspective of things I could pick his brain on, and he just thinks differently, right? Just in everything in business, one of the best business coaches, one of the top guys when suicide calls come in and things like that. So I think it's very well-rounded from a business perspective, as well as just like a real life kind of perspective.
Awesome. Okay, Mike, if you weren't doing what you're doing today, what would you be doing now?
like right now, like if I wasn't in this,
Yeah.
or if I wasn't, oh, I'd probably be at a Christmas party for a company that I help out with
No, no,
acquisition.
no, no, no. We're talking about your career. If you weren't doing, if
Oh, but that's why I asked. No, this was my dream career. I always knew that I'd get into real estate from a teenager one way or another. And it's weird to say, but like, it's kind of fit in perfectly for me. Like, it's been growing at a pace faster than I thought things would kind of grow at from a young age. I love what I do. I do have the freedom, like, to do what I want to do, and I'm choosing to do what I want to do. I had a previous career, but the reason I became a licensed plumber and got into construction was because I knew I wanted to renovate homes or flip homes or do something in real estate. And now I'm in the position where I'm kind of sitting at, the 30,000-foot view, kind of managing what pieces to come in, who should we be hiring, what assets, where should capital be coming from. So like I said, if I won 50 million tomorrow, I'd probably be doing the same thing I'm doing now.
Nice. How are you, Mark?
So what would I be doing if I wasn't doing this? I think I would probably still be, I don't know, in like the consulting space. But I didn't enjoy it. I didn't enjoy it so much. And that's kind of why I got out in the first place. Because it, was a lot of travel. And then, when your kids ask you if you're coming home for dinner, and most of the time you say no. And I kind of, I saw that the long term of that just wasn't going to be good. So I could still be there. Who knows if I wasn't doing this? But I think those that are looking to leave the 9 to 5, it doesn't happen right away, right? I think it takes planning. Like for me, it was like literally probably a 5-year kind of plan. Like, okay, at this point, it's gotta, it's time to exit. Yeah, I'd probably be still doing that, but not as happy as I am now. I think now with the flexibility, the growth of the business, we're doing some pretty cool things. The people that we're working with, the collaboration, it's just so much better. But but there's a lot of people that I think become complacent, right? And I've heard it a few times already this year. For example, like, oh, I got 15 more years and I have my pension. I'm thinking, oh my God, this is crazy. Wow. Let's like take control now, and I think it's a very small percentage of the population that I think, gets off of that, complacency path. And it's not an easy thing to do, but I think the end benefit and the rewards, psychological rewards, the financial rewards are well worth it.
Well said.
we should have
I'm sure. Go ahead.
Go ahead, Mike.
I was gonna say, I'm sure you guys are the same, but when money's just sitting there, capital sitting there, like for me, it's got to be somewhere. It's got to be in this investment, that investment. If I'm learning the stock market, I couldn't just sit back and put a movie on and relax. Like that's a struggle that I have, is kind of separating to have that time to unwind. I don't want to think about something, because a lot of my internal friends, like really close group of friends, they're all involved in real estate. So when we just hang out, the conversation gets talked about, where are you buying? How are you buying? Who did you hire? Right. And that's like kind of amalgamated into just my friendship kind of lifestyle. Right. Which I don't know, it may be good, it may be bad. I don't know. But, I did struggle when I did leave a full-time job to kind of unwind and say, hey, I'm taking the week off, nothing to do. And it's my choice. It's like, no, where can I go back to work? When can I go back? And I often, like 10, 11 o'clock at night, like searching for properties or responding to emails or doing whatever. I can't sit there and do nothing. It's a challenge. And I think there's benefits to doing that and unwinding. And that's something personally that I'm actually working on.
Good for you. But that's also beautiful that you're living, like you're doing what you truly love every day, and it's not work to you. That's your life. Your purpose.
Yeah.
Incredible. Okay, who am I going with here?
I'll just go with Mike, I guess.
Mike?
Yeah.
Okay, this is our favorite question. We're almost done. Book smarts or street smarts?
I think a bit of both. And one of my professors, there's something he said way back when, and it stood out to me. If you're going to study, and he goes, and get a 90, 95 in my class, I'd prefer you go to the bar, have a couple of pints, meet a bunch of people, and get 70 in my class, because nobody's going to know what mark you got. But as long as you passed my course, if you know the guy hiring or have the connection, or he's got a connection, you're going to be the one getting the job. or starting the company. So I think you need a bit of both. I think there needs to be the mixture. Street, like, this is something that I opened up a whole new, world for me, is a lot of people in the like higher end business world, they're really good at connecting people. And that's what business is, just connecting people and, enjoying, their company. They might not know anything, but if I have someone who can just, gel with me, go out for dinner with me, find me properties, I'm going to pay him a lot more than someone else just that's super book smart and says, this is where you should be finding, and this is who you should be talking to. So I think it's just really finding a way to genuinely connect with people and put other people in connection with other people that, right. And mend those relationships, because I think it comes back tenfold. Right. So realistically, that's where a lot of people say the money's made on the golf course. You go out, you have a beer, you chat through 18 holes, and that's where the money really gets made, is in the relationship. So I think there does have to be obviously some book smarts. You have to know what you're doing and know how to analyze things. But I'm a huge believer of like a 50-50 split.
Nice. How about you, Mark? Book smarts or street smarts?
So yeah, so my perspective has evolved over time. So early in my career, it would have been like 90% book smarts, 10% street. Just I think the people I was around and MBAs and PhDs, it was a real part of the business. But then I think as you grow a business, you realize that it's just not about book smarts, right? There's everyone has like this emotional capital, which is hard to be, or emotional intelligence. And like Mike said, kind of dealing with people, and just also kind of just to be able to sense things. Like you don't have to be, especially in our business, right? Like you don't have to have a university degree or an MBA to really understand real estate, and even real estate math, right? Like it's a little bit of intuition. Yeah, you have to understand some economic concepts, but I think, you don't need a university degree to do it. Also, I think what's happening too, with YouTube and stuff you guys are doing, we're doing, and a lot of people are doing, is you can learn a lot of things from, the internet, right? And just, what's being out there. And I think our economy allows people to test and learn fairly quickly. So try things, fail, okay, do things again. So, and that doesn't come from book smarts. That's personal drive and, I guess, quote unquote, street smarts. So yeah, my perspective has definitely evolved, and it's evolved so much that, when talking even to my kids, yes, education is important. I think it's more of an insurance policy now than something that's absolutely required.
Right on. Okay, last question. Let's go, Mark, first. If you had $1 million cash and you had to make one investment today, what would it be?
$1 million cash, what would I do right now? It would be buy an apartment building. I'd buy an apartment building right now. Yeah.
I was just waiting for him to say that. Nice.
Well, because I'm thinking like, do I buy a Bitcoin, or maybe do I buy into like Bitcoin miners? Like, no, too volatile. Buy an apartment building, and it's safe. We've done well with it, so I know that we're going to get a big return out of something like that.
Nice, Mike. What would you do?
I'd probably put a large portion of it into cryptocurrency personally. Well, maybe not a large portion, but I would say 50% of it into the stock market and maybe 25% of it into cryptocurrency. And the only reason I'm saying that is it's been, I don't know, a couple of years now where I started to realize that majority of my net worth is in real estate. I make money from an agent. My investments are all held in real estate. So just for, diversification purposes, I would probably put 500 grand into stock market and crypto.
That's a message to all other investors who are focused on other asset classes, is diversify into real estate, and real estate private equity is the best vehicle to utilize. So
absolutely
excellent way to complete the show. Lastly here.
Yeah, Mark, maybe tell people what's the best way to reach you.
So Mark at peakmultifamily.ca is kind of email. peakmultifamily.ca, the website. Mike and I are on social media. So Instagram, LinkedIn, Facebook. pretty active in that. And I think those, yeah, I mean, any of those channels, we're pretty responsive. We get messages or even emails, and our website has a ton of, educational content, that can help at any stage of your investment career.
Nice. And Mike, what's the best way?
Yeah, it's Mike at peakmultifamily.ca, and the same platforms, all the social media platforms, people can reach out.
Awesome. Really glad that we had you guys on. Really glad we had the Canadian multifamily and US multifamily, somewhat of a debate and conversation.
That's right.
I'm sure people are going to get lots of value from you guys speaking. Look forward to staying connected, and thank you again.
Yeah, thank you guys, and Merry Christmas.
Awesome. Yes. Merry Christmas to you as well.
Thank you guys.
Thank you.